Cool. So Andrew, you want to tell us about yourself? Where are you calling from? Or I sound like a radio host. Where are you calling from, Andrew?
Andrew said that he's at New York,
Buffalo. Buffalo, New York. Good opportunities to do real estate in Buffalo, New York. Buffalo, New York, Worcester, Springfield, all those places have inexpensive real estate compared to the rest of the world, like New York City and Boston, Massachusetts. Buffalo, the capital of New York. So Andrew, what is it that you're trying to learn? What I think is this the second time you joined our webinar? First time, cool. So I think we had someone else with a similar name because we started doing these webinars on Friday. But what are you looking to learn on these webinars? What are you trying to like? I'm just trying to see if I can give you something of value because we had like 5 people register for this webinar. And a lot of times, well, some people just register for the sake of registering. So I can teach you about paying little or no taxes in real estate. Or I can just send you the newsletter and you can take advantage of the opportunity that we are one-on-one and ask a lot of questions that might be relating to something more personal to you. I don't know if I can share my screen. Host disabled, share screen sharing. You want to share your screen?
You can share now.
We can talk about some paying little no tax. We can talk about a depreciation for 27.5 years. We can talk about a 1031 exchange, taxes on home equity line, the tax deferment for married couple or single on owner-occupied property. We could talk about the principal interest tax and insurance, the ITI deduction on the principal interest. We could talk about the impact of real estate taxes. So there are some stuff we can talk about. Or I could just send you this little news articles and then you can tell me if there are things that awesome. So you bought a property in New York, and you would like to know how to pay less tax. So there's a couple of things that, okay, first thing I have to disclose, I am not a CPA. I cannot give you tax advice, legal advice, because I'm not an attorney, I am not a CPA, and I have not been hired by you to do those kinds of roles, even if I was. So this is for educational purpose from the perspective of a real estate investor and a real estate instructor. So if you just bought a house in New York and you're now homeowner, there's certain things that you can take advantage of as a homeowner for tax purposes. But the first question that you have to ask yourself is this an investment property or is this a owner-occupied property? Do you live in that property, Andrew? Or is it Is it an investment property? Do you rent it out and collect rent from it? And the reason why I'm asking that question while you're typing it, the reason why I'm asking that question is because if it's an investment property, then there's a little bit more, I think, in tax savings that you can get. Now, you can have depreciation on the property. Depreciation is a paper loss that the IRS allows you to write off in exchange for the property losing value over time. And that the IRS understanding and acknowledge that in order for you to maintain the value or grow the value of your asset, you have to do certain things to that property, like rehabbing it and maintaining it and upkeeping it and beautifying it and all of those things. So what they do is typically they let you take the value of the property and deduct or reduce or subtract the money for the land. And an assessment of the value of the property could be, for example, you bought a property for $200,000 and the land value is worth, I don't know, maybe say for the simplicity of math, $100,000. They'll let you take $100,000 and divide that over 27.5 years if it's a residential property. And that 27 years over 100 grand, that means that every single year you'll be able to write off 2,000 and some change or something like that, whatever that number comes out to be, 100 divided by 27.5. When you divide the two, every single year on your income tax, when you're paying Uncle Sam, federal government, for your tax on the income that you've made at your job or the income that you've made with your job plus other revenues, they let you subtract the depreciation before the balance is taxed. And whoever does your tax will just ask, when did you buy your property? Now, the cool thing is that you can also write off capital expenditure on that. So if you bought a property for $200,000 and you spent $100,000 fixing it up, you have to give both dollar amount to the CPA or the accountant, and they'll add it up and then divide it over to 27 years. And every single year, if your tax burden, liability or whatever to Uncle Sam was going to be, say, $5,000 every single year, you do the $5,000 minus the, let me say it in a different way. If your taxable income every year is like 50 grand, you'll do the 50 grand minus the amount of money depreciated from the real estate property. And then that balance is going to be what's going to be taxed at a tax bracket, because you probably know that you get taxed from your income on a scaling method or model. I see we have Carl on that has just joined. Hi, Carl. So we had like 5 people joined. 5 people joined. 5 people signed up, but being that it's a very small class, I thought we'd just chat and trying to do the Q&A and try to give you guys something of value that would benefit you. So that's what I'm doing with Andrew at the moment. So he's asked a question about, he bought a property in New York and he's trying to figure out how to mitigate or minimize his tax liability on it. So I was saying that one of the first ways that you do this is through depreciation. So part of the property value every single year will be allowed to be a paper loss, not a real loss. So whether you spend the money or you don't, you'll get the chance to write that off. That's the very first thing. So that's the first thing that you can do. The second thing that you can do is to take notes of things that you are doing with the property. For example, if I see that you said that the property, you don't live there. So I see that you don't live there, so it's an investment property. So for investment property, you can download an app and track how far the property is from your personal owner occupant residence. So for example, I live in Massachusetts, and I have properties in Massachusetts and all the way down to Washington, D.C., where I'm originally from. And it gives me an opportunity as I'm driving down 95, when I stop in New York, or I stop in Jersey or Philadelphia or Baltimore or the District of Columbia, every single trip that I make down, or every single trip I make up, even if I'm going to visit friends and family, where I'm originally from in DC, those trips becomes tax deductible. On a larger scale, it adds up, but on a smaller scale, it might add up if you're making 2 or 3 trips to the property a month kind of scenario. So what is essential then is that you are not being considered a real estate investor. So the miles gets written off, the gas gets written off, the car gets written off because you use the car to get to the property. So those things are tax write-off. And because now you have a side gig, even a portion of your house can be written off if you sit there and manage your property as a property investor. So those things are things that you have to keep track of now. You literally have to keep track of the mileage and then provide those mileage to your accountant so that they can write off the miles that you're driving to the property. They can write off the gas, the insurance, part of the car, if you use part of the car to do your business. And then if you set up your house where you have a desk or a room or something like that, where you're writing things to your tenants, leases, contracts, bills, whatever, negotiating with contractors, that is your business now, and that becomes profitable. So let me say this one thing. And Hector, you can give everybody opportunity to speak if they want to, because it's a small meeting, so they can ask questions that they want to ask. So let me say this. Real estate should not be I know a lot of people talk about you buy a property when it's making cash flow, positive cash flow. It's a wonderful thing, but not every single one of your property are going to cash flow out. And if it doesn't cash flow out, you shouldn't despair. You shouldn't lose hope. It shouldn't be the end of the world, because I'm going to sidetrack a little bit, because sometimes real estate can give you benefits above and beyond the cash flow of the property itself. So for instance, if I have a property that has a negative rental income, but the depreciation, the write-offs, and all the other things minimize my tax liability on my income statement, I think that that's still a win-win situation for me. Because eventually, over the long term, that property should grow in equity. And when I dispose of the equity, I will cash out my profit at that time. So if I make $100,000 a year and my property is losing me $10,000, my taxes on my income is 20 grand. I just reduce my taxes by at least 10 grand. A big chunk of my losses on my real estate property is going to reduce my tax liability, because part of my business is a real estate professional, and that real estate professional allows me to write off and reduce my tax liability, even if the rest of the income is coming in from other things other than real estate. So if I have a full-time job and my job is 100 grand, owning real estate under my name or under my LLC or something like that can give me an opportunity to write off, to reduce my income tax liability, both to the state and the federal government. So that's another point to keep in mind. Now, If I do that for a number of years and I get tired of property, or the depreciation number goes down, or I find a better investment, I can then flip that property or dispose of that property. And if I have made profit on that property, I can do a 1031 exchange on the new property. What is a 1031 exchange? A 1031 exchange is the tax code. That's why they gave it the word, the name. It's a tax code that allows me to defer my taxes from the profit of this to the next one. Now, because we have new people, I should reiterate this. I am not a CPA. I am not a tax guy. I am not a licensed to give tax advice or legal advice. I am just sharing what I do as a real estate investor. So please keep that in mind. So all of these things should be verified or ran through with your own CPA or tax guys. But sometimes the people that do your taxes are not real estate people. So they just have a basic understanding of income tax and they do W-9s. So some people might not be familiar with all of the ways that you can do these things. And other people, they just go to traditional H&R Block, and H&R Block does the tax, and then they go home. And then when you sell a property, if you didn't know that you can do a 1031 exchange, H&R Block is just going to charge, is going to put on your tax that you have capital gain on the sale of a property, and you'll get charged capital gain tax on it. So proper planning is always better than just last minute catch up. So 1031 exchange is a vehicle that you can use to move out of that first property into something bigger, better, of a like kind exchange. That's very important. You cannot do a 1031 exchange on a property that you live in. 1031 exchange has to be an investment property to an investment property, and it has to be of like kind. And like kind is very vague. Like kind can just be, I collect rent on property number 1. I'm trying to collect property rent on property number 2. Therefore, it's a like kind exchange. It's a rental income, whether it's residential to retail, or whether it's industrial to mixed use, or whatever it is. Like kind can simply be the revenue or the source of income that you're getting from that property. So there's 1031 exchange, there's the depreciation. Here's another cool thing that I have done in the past. I've bought an investment property. I've rented it out for a very long period of time. When I knew in the near future I was ready to sell it, I moved into the property. And I didn't want to do a 1031 exchange because there's this owner-occupant tax exemption where if you live in a property for 2 years out of 5 years, you can sell that property in the first $250,000 for a single person. You pay zero tax on it. If you are married, first profit for $500,000, you pay zero tax on it. So if you are ready to sell that property and you move into the property, and you stay there for at least 2 years out of 5 years, when you sell it, no tax. You just have to have the information, the record that the IRS has to know that you live there in case you get audited for it. So there are some ways that you can minimize your tax liability. Let me see what are the questions I can answer. Should I talk about Airbnb? Airbnb income can be taxed. Airbnb income can be taxed as active income. So you might have a higher tax bracket than a passive investment kind of income. But there are a lot of benefits that you get from operating an Airbnb, for example, if this municipality allows. We own some properties in southern Massachusetts that we used to do Airbnb because it was a vacation area. And even coffee and donuts and all these things, a lot of it, I admit, we had opportunity to enjoy because we would go and do those events and hosting and things of that nature. But all of those things are deductible, tax deductions. So if we will go to the grocery because we have to fill the fridge, or we go to Target because we have to buy cleaning supplies, or we go and bought towels and bed sheets and furniture and all of these things, we had an opportunity to write off everything. I mean, like, as a matter of fact, I think Hector helped me out putting together my 2018, 2019 expense sheet. And I think we spent, I mean, when our tax guy saw the sheet, he's like, "You're writing off grocery? I mean, that's not a right tax write-off." Then I had to explain to the tax guy, listen, I operated an Airbnb for about 2 years, and we used to go to the grocery because we wanted to give our Airbnb guests a home experience, and we would fill the fridge. And if they didn't eat it, we would get a chance to enjoy it. But the intentions and the activities, and that was for that purpose. We went and we bought it. And instead of dumping in the trash at the end of it, we had a chance to enjoy it. So Airbnb can give you a lot of tax benefit because it becomes a tax write-off. So that was a cool thing that we did. So Airbnb could be beneficial. Our tax is the same for small office, 2-floor building, not big, but I'm thinking to buy it. Concerned about the taxes and the depreciation. No, commercial properties are taxed. Okay, the depreciation on commercial properties are taxed longer, so you get a longer benefit of the depreciation. But municipal tax on real estate is higher on the commercial typically than it is on residential. But this is a big but. Municipalities have the right to tax anything they want, any way they want. Because here's the myth. Tax on municipal property are not something that is governed by the state or by the federal government. Taxes on real estate are municipal, and it's always based on the budget of the town, not based on the value of the property. It's an illusion that they give to the homeowners that because your property is worth $1 million, we're going to tax you on the value of $1 million on your property. That is not true. It's an assessment. It's someone within the municipality comes up with a figure that they think that you're not going to argue with on the value of your property, and they put that as the value of your property, and they have a tax rate that the municipal board members or municipal governing body came up with through votes, and that could be 1%, 2%, 3% or whatever the municipality is, and they charge that to make sure that the budget that they need to pull from the community is equal to what they need to spend. So when a lot of people go out there and do what's called an abatement, a request for a review or reduction of that, all they have to do is vote to increase the tax rate so that their budget is still covered. You can see a house that's worth $10 million still getting taxed at $1 million because $10 million owner has not done anything to the property. He hasn't improved it. He hasn't pulled a permit. He hasn't sold it. Hasn't done it. He hasn't bought it for nothing has changed on our property for 15 years. So the value of that property remains almost the same as when he bought it 15 years ago. The next door's property has been sold and bought a bunch of times. And that property now has gained value. That property's value will change more frequently than the other property. And that person will pay a higher tax than the other guy. So municipal tax are always based on the budget that the municipality needs to pay for their firefighters, their teacher, their police officers, the mayor, the lights on the streets, those kinds of things. That's what they use those, and sometimes certain community, like for example, mine, they send me a quarterly report of 30, 40-page book that tells me what they're doing with the money that they're collecting on my taxes. So, but commercial properties that are taxed separately than residential. The other thing also is that properties that are in commercial intensive communities tend to have lower residential tax and vice versa. So if you're buying an office space in a community that has really low commercial activities, the residential tax will be higher. So there are different ways to do this, to do these things. So, and you can go to the municipality and get a tax sheet or a tax form or a tax, depends on the city. Everybody calls it something differently, but tax bullet. And it's just a piece of paper that has the sheet and information and data on the property and the tax and the history of it and things like that. You can also Zillow it, and on the bottom, it gives you a track record of all the taxes that has been paid and the assess that has been done and all of those things to figure out. And they can also predict what it will be the following year, because the assessment comes with a predictable model that can see how properties are going to grow and not grow in the near future. So, but the cool thing about buying commercial properties that you can put tenants in the property through what's called the triple net. The triple net means that you are passing on the tax liability to whoever you're going to rent it out to. And triple net simply means that you're netting the lease. And if you rent it out to some guy and you say, I want a triple net lease, if the tax goes up, that tenant is responsible for it. If the tax goes down, that tenant is responsible for it. That tenant will be responsible for tax, insurance, water, sewer, and anything else that you want to do, even CapEx, capital expenditure, or whatever. So you could do that. Yeah. Is it a good idea to purchase property in different states and rent the properties, or is it better to focus on one state? That's a really good question. Personally, I think that is a personal or individual question. I think that if you are a traveler and you enjoy it and you don't mind doing it, owning properties in different states is cool, because then your trips become tax deductible, since we're on that topic. If you are a one-man operation and you travel rarely and you have a job and you have responsibilities, owning a real estate property in different states can be challenging. It could cause a lot of problems, because if a toilet breaks, of course, there are ways you can mitigate it. You can put the type of insurance that can fix the property's damages, not necessarily fire insurance, but there are different home insurance or home protection or home, what's the word I'm looking for? Home warranties programs out there that can do those things for a small deductible. So then owning a property in different states can mitigate that risk. So for example, if we look at the crash of the 2008 market, there were a couple of markets that was hit harder than the rest. 2008 crash, I was in Massachusetts, and I can tell you we didn't feel a major hit in the market. We saw property drop 20%, 30%. No big deal. But places like California, Florida, Nevada, places like touristic areas, we saw property drop 60, 70, 80%. I could have bought a property in Florida in 2008 for like 50 grand, and just 10 years, just 2 years earlier, it was selling for $500,000. So if you were a Florida operator, it would have been cool to have assets in Massachusetts or New York or someplace that are more stable, like Washington, D.C. But if you were a Washington, D.C. operator that didn't drive, that didn't commute, you would have freaked out if you own properties in Florida, because you just saw a $500,000 purchase that you did drop to 50 grand. And you see your property in New York or Washington, D.C. that didn't see that same impact, you might have sold in panic because you saw it as a bad investment. So it really depends on that strategy. Owning a property in multiple states can be advantageous if you take advantage and go to Florida on vacation. Owning that property, you can ride out the bad times. If you have a bad couple of years, no big deal, because you travel there, you enjoy the property, you enjoy the potential return that it can provide, and the stability. So that is my opinion, but that is a decision for the individual themselves, because there's a lot of other factors that has to go into play. For example, I own properties from from Washington, D.C. all the way to Massachusetts, because my family is in Washington, D.C. I am in Massachusetts, and I make the frequent drive between the two. And I know that megapolis is a stable market, that employment is very strong, recessions resistant and resilient. And the things that can happen to that is going to buffer whatever obstacle we have a lot better than places like, I worry about investors in Indiana. My brother does real estate in Indiana. I worry about investors in Indiana because Indiana is a replacement cost value. So if market crash, Indiana, someone could just replace the house that they're looking at simply by buying land next door and just rebuilding it. If labor and material cost goes down, the value of the property will go down. But in places like Massachusetts, all the way down to Washington, D.C., even if you can find land, you have to go through the obstacles of building and regulations and environmental and all these problems comes up. So people rather buy something that exists versus building something that does not exist. So there's some advantages in that. So, and that's based on market cycle. Let me see. Andrew, how long have I been in this business? Yes, sure. So I've been doing real estate since I was 19 years old. After the military, I was a Marine for 5 years, and I bought my first house at 19. I owned a RE/MAX franchise at 21, 22. When I got out of the military, I bought a RE/MAX franchise. At 27, I opened a real estate school. Boston Realty Institute is a real estate school. And today we're looking at transitioning out of real estate education to doing real estate syndications. And the reason why we're transitioning out is because the pandemic has forced us or limited our ability to teach real estate agents and brokers on how to do their business, because that's what our focus was. We used to teach real estate agents and brokers how to obtain their real estate license, continue education, and pass their real estate exam. So that was our business for like 15, 16 years. And when the pandemic happened, we were restricted at doing that. And because I have a lot of experience in real estate, we are looking to doing real estate syndication. What that means is that we're going to be advertising to get people to pull money together and do real estate projects and pay them a certain return, either on an annual basis or over the long term. So that's what we do. I have a bachelor's I started my bachelor at Harvard, but I finished it at Georgetown. So my bachelor's from Georgetown and my master's MBA from Georgetown as well. So that's a little bit of background about me. Yeah. So let me see. We're trying to do a real estate class. Let me see. I'm going to just close the chat. We're running out of time. We're trying to do a real estate class. And since we have Andrew and Vera left on the chat, maybe you guys can give me some tips. If you found this valuable, let me know. But maybe you guys can give me some tips on how to do this. We're trying to start some real estate education for investors, particularly for investors. And it's going to be a weekly meeting for 2 hours. And we're going to do Zoom meetings. Then we're going to do Slack or Discord. And we're going to do, bunch of one-on-one sessions with 26 different topics that we're going to cover over the period of 6 months. And at the end of the 6 months, we also have the opportunity for us to guide you through your own projects if you have projects, and or we have opportunities for you guys to invest in projects that we're doing in our market. And it's going to be, again, 6 months with 26 different topics, 26 different weeks, where we're going to be doing this project. And we're thinking about charging $1,000 for the entire 6 months program. Can you guys write on the chat what you guys think of something like that? So if you can give me some feedback. Yes, that's true, Andrew. So we are literally just starting our YouTube adventure. I don't know how to do YouTube, so I have Hector that's helping me out with some YouTubes. But we are trying to blast some ads to fill this space so we can get some feedback, ideas about the two things that we're trying to do. The first thing is the syndication, where we're pulling investors from a pool of people to do investment project and giving them a return. And the other one is to do some investors specific education. And we thought that if we give something of value in Zooms like this, we might get some feedbacks that might tailor our presentation to the public. So give and take kind of scenario. Wow, $45,000 per month. Nah, we're thinking $1,000 because we're trying to do more of a community style kind of thing. And the community style kind of thing is that, okay, we do one webinar a week, we do newsletters, we do homework and assignment and things of that nature. And because we are a real estate school, an accredited real estate school from the state, we can also teach people the same thing that we teach real estate agents, so that you know as much as real estate agents do. And then from that, we build a community where people can interconnect and then do real estate projects together. But we're trying to do it on a larger scale where we have more than, maybe 100, 200 students in that. And I think that's more fun, more interactive than just having $4,500 for 5 or 10 or 20 students. Yeah. No, Hector is my assistant, my office manager. Thank you, Andrew. I appreciate it. Okay. All right. Well, I appreciate your time, everybody. I think I've kept you guys for 40 minutes. I appreciate the patience. Hi, Vera. Do you have any questions before we let you go? Vera Wang. I like your name. Famous. Okay. No question, Vera? We good to go? Awesome. She disconnected. So.
Do I pause the recording now?
Yeah, you can pause the recording.